how DeFi is going to infuse itself with traditional finance. And we've got a fantastic panel with us tonight. So if you're able to introduce yourselves one by one, that'd be great. Should we start near side? Chris.
Yeah, hi, Chris Rulio. I head up product at BCB Group. BCB provides banking and payment services to the crypto industry.
I'm Tina Baker-Taylor. I'm the Chief Policy Officer at the Chamber of Digital Commerce, which is a lobbying and regulatory advocacy association based in Washington, D.C.
I'm Sean Kiernan, the founder of GreenGauge, which is a startup digital merchant bank. We do lending against crypto today and lending for crypto miners.
How you doing? I'm Brian Rose. I'm the founder and host of London Real and the DeFi Academy. We've been broadcasting conversations for about 10 years, and the last 6 months we've gone heavy on DeFi. I also ran to be mayor of London in the first 6 months of this year. You might recognize me, and just excited to be on this panel.
Great. Well, it's great to have you all here. Thanks so much for being here. I wanted to start with, obviously a lot of institutions are looking at DeFi as a potential future option. What do you think their biggest fears are when entering the space? Start with you, Brian. Sorry, Chris.
Well, I think there's a couple of things. Obviously, the first thing is counterparty risk, right? It's not so much that in the DeFi world they're not facing an institution, but who's in the pool, yeah? And then also regulation, yeah? From the conversations we've had with folks in the industry, institutions, they want to participate, but top of mind is, who's in the pool? And then on the regulatory side, do they have the green light to go ahead from a compliance perspective? So I think those are probably two of the things that are on their mind.
Yeah, I think to move on or to expand on the regulatory concerns around KYC, AML, and just standard compliance practices, there's also quite a lot of concern around accounting standards, reporting requirements, tax issues. So, all of the things that DeFi is designed to potentially make more efficient by removing the intermediary for an institution. They're used to having those intermediaries do those things for them, and they're not great at being their own bank, right? So we talk a lot about that. And as individuals, we kind of grapple with those things, reporting our taxes accurately. But for an institution without those kind of institutional infrastructural services, it makes it very challenging.
Sure. Thanks. I think the biggest issue is identity. So knowing actually who is on the other leg of the trade. Institutions can't really place funds at scale if they don't know if the other leg of the trade is potentially an illicit actor or if there's proceeds of crime. There are solutions to this, and I think the fascinating thing is to see the growth to the scale that we've seen today. I was looking this morning, I think 270 billion have been staked in DeFi, which is incredible. But we haven't yet found out which solution is right, if it's the walled garden approach, whitelist or blacklists for certain wallet addresses, if that's the route that it happens. And I'd like to kind of explore that on this panel as well for thoughts.
Yeah, it's a great question. We've been lucky to sit down and have live conversations with some of the top 50 market cap blockchain companies. And when I did a straw poll this week, they kind of fall into two different camps. You've got Stani Kulichev of Aave, whose office is right around the corner, and like a Robert Lesner of Compound, who think it's all about liquidity. Stani said there's 100 billion now locked up in these platforms, and that's what institutions need to see: liquidity, liquidity, liquidity. And they're doing their own kind of mini fintech companies on the side. I think it's Compound Treasury, Aave Arc, where they're trying to bridge to institutions. Now you go over and talk to the Nexo guys, or Alex Mashinsky from Celsius, and he said, Brian, you do KYC and AML, and the institutions will follow. And they think it needs to be clean money and clean customers there, and that will bring the institutions in. And then, of course, you've got all the really big question marks around regulation, that I'm sure Tina knows a little bit more about. But that's what I see. It really divides right down the middle. And the hardcore decentralized finance people are going into the DEXs, and the other people are like, no, we're doing our due diligence. We know it's painful, but we think that's the way to the future.
Yeah, I just wanted to pick up on Sean's point there, which was obviously DeFi by nature is fully decentralized, so you may not be able to actually see the people behind the projects. So if you think from a traditional financial point of view, when you're putting money in, how do you think that fits in with either something that's fully decentralized or something that's more centralized, where you know the people behind the DeFi project?
I mean, I think obviously given the scale I mentioned, money is going in, and there is institutional money. I think the actors that are going in are the family office or market maker type institutional players. But the big houses, the pension funds and the insurance companies can't yet engage at scale because obviously it's not regulated, there's no clear identity. And I think there is going to be a tipping point where, and I don't know exactly what figure that will be, but there will be an incentive to do what the Celsiuses and the various CeFi actors are doing and do KYC. And I don't know how that's going to emerge, but I think it will happen.
Sure.
Yeah, I think if we go to actually what DeFi offers, which is, if we look at the current traditional finance system, where do you get a return right now? And we bank customers with euros. If they're holding euros, you're paying your bank to hold those euros. So any solution out there that's going to give you 3%, 2% on your money, you're drawn to it, right? Sure. So obviously retail's headed in, BlockFi, Nexo, etc. Huge growth on the retail front, and institutions have the same mindset that they've got cash, they're paying for that cash. If someone's coming along with a solution that is within a regulatory purview, that is that they feel comfortable with, that gets over their risk threshold, then they're going to come in. To Sean's point, it's clear from the volume that is there, that's locked up, that institutional money's already in, and it could be the early adopters, but then, definitely we've seen in the news recently, I think ING have come out that they're, exploring this, and for a bank like ING to be saying that shows actually where institutions are at with this. Yeah.
I think the one thing that I would add that we haven't covered is kind of the ecosystem that sits around DeFi. And so from a regulatory perspective, one of the challenges that we're seeing today across the globe, but really heating up in the US, is the regulatory framework that underpins stablecoins and what's actually in those stablecoins, how much of those stablecoins are actually backed by cash and cash-like products as opposed to commercial paper. What does that commercial paper look like? And so if there has been some concern, we've heard it from the Financial Action Task Force around DeFi. They have kind of backed off a little bit. The check's in the post on that one. I think, we'll see what they say in May, but they have said that they need more information, so that's a good thing. But one of the ways that you can regulate around DeFi to prevent some of those institutions, actively prevent them from coming in, is to start to kind of attack the perimeter. And stablecoins are massively integral to the DeFi space. So I think that we can't kind of look at it just in its own. I agree that liquidity begets liquidity, 100%, like absolutely. But then when we're looking at banks, for example, banks are regulated, and I don't think most people know this, by a completely separate set of regulators. And so, you've got the FCA that oversees certain types of activities, but banks are also overseen by another global banking supervisor, essentially. And they're looking at what level banks should be allowed to partake in this ecosystem in general. And so when you put DeFi on top of all of that, to me, it feels, when we talk about institutions, there's definitely institutional money, but I just don't know how ING is going to get around the Basel Commission.
Just to add something to that, one thing I've seen, my guess, is they've started to change the language, because language is everything, where DeFi was typically versus the CeFi banking sector. Now, someone like Mashinsky will say, the banks are TradFi, and we're your friends in CeFi. And so they're trying to kind of bridge that gap where we're saying we're not kind of control everything or give you that old banking experience, but we're also not trying to take away all of the regulatory issues. So that's one thing that's interesting. Second thing I'd say that's also interesting, in addition to liquidity, is speed. I had Eamon Gunsir of AVAX on the show, And he keeps banging on about the big elephant in the room is speed and lack of speed or efficiency on Ethereum. And he talks about 750 millisecond transactions, and he said that's really what the sector needs. Again, more of the tech and liquidity side. And I think there was something called the Medici Conference in LA recently where he said behind the scenes, he's hearing that, you know, trillions of dollars want to come in. He's never seen something so optimistic for his protocol. But again, it all comes down to these questions. And the stablecoin question is a fascinating one. It's the question, and like Tiana said, there's this new committee that came out from the president talking about that. Then there's the SEC, but then there's the FDIC. And last thing I'll say before I pass it over is I had Professor Silvio Macaulay yesterday of MIT, who actually was a colleague of Gary Gensler when he spoke at MIT Sloan School of Business. I went there as an undergrad. And he said that, you know, he's a good friend of his, and he thinks he's a very smart guy, but he thinks we need clarification on regulation. He said nature abhors a vacuum, and he thinks there needs to be 4 guidelines. He thinks it needs to be something that's cost efficient, scalable, it has consensus, and it's also environmentally friendly. And he wants the regulators to call out the blockchains that are that. Anyways, that's his point of view, and to be continued.
Do you have anything to add?
I mean, maybe just to caveat that, I mean, DeFi is fascinating. There's so much that's going on right now. Could be solutions to TradFi or CeFi even problems. One thing that I've been kind of really noticing in my career is that every bank does KYC and AML, and everyone does that independently. And everyone is then repeating the same cost. And if we could use solutions in DeFi to share those costs as a community, not only are we better off, but the community's better off. And I think that's just one sliver of an example of kind of what this technology could unleash if we do it right.
And obviously, the topic of this discussion is about how DeFi can make the leap to institutions. Obviously, Brian, you're fairly plugged in with a lot of the senior people there. If you were running a protocol, or if you're speaking to a lot of these guys and girls, what would you do? How would you position yourself to be the most attractive to traditional financial investment?
It is interesting to see these two split, and again, I keep seeing in my eyes, you know, Stanley Kulichev, who built this entire Aave protocol in the DeFi summer of 2020. If it wasn't for that, we probably wouldn't be having this conversation or be using the word DeFi. So they're all about liquidity, create the tech. Emin Gunsier, again, professor at Cornell, is all about speed, speed, speed. There's nothing to talk about here. If we're still based on this Ethereum blockchain, there isn't much to talk about. So they definitely, without that, there is nothing to talk about. But you also see all the regulation happening in America right now and all the states coming after them. And if you don't have KYC and AML, even if you do, you've been shut down from taking on new customers. And last thing I'll say, I was actually at the Miami crypto conference just a few hours ago. And I had the founder of Hi, which is a protocol based in Hong Kong, and he used to be the chief marketing officer of Crypto.com. And he said, we're doing KYC in a gamified way via WhatsApp and via Telegram, and we're trying to find a new way of doing that to where it doesn't have to be this grit your teeth and grind your way through it. That seems to just lose a lot of the people that are excited about, you know, the transparency and the independency of a blockchain. I don't know who's right. It's some combination of all of them. But I would say if you don't have KYC on your platform, it's going to be very hard to tap into these institutions, and they're probably going to maybe stay away from you as opposed to others. But again, all of this is changing even in the last 3 months that I've been speaking to these people.
Do you think there's well, to all of you, do you think there's a fear within DeFi of regulation as sort of a wall coming that everyone needs to prepare for?
I don't know if there's a fear, but everyone knows it's coming. Yeah, I think it's inevitable, isn't it? But then, you know, what do you, on this topic of regulation with DeFi, what do you regulate, right? Because there aren't companies that you can regulate. You're fully decentralized, a true sort of DeFi protocol is fully decentralized. So, you know, what does the regulator touch? We talk about at BCB as the sea and the ports. The regulator's unlikely to regulate the sea, but they'll regulate the ports. Right, so definitely sort of any fear on-off ramp point, that's an obvious one. But you know, if there's any entry point or exit point, that's likely to be, you know, where the regulator's going to look.
For me, I see 2 camps, which is not unusual in crypto. So you have the camp, Stanny is a great example of building a thing and then kind of getting halfway through and thinking, wait 1 second, and really looking holistically at the opportunity and not wanting to leave any money on the table. And so approaching this from a way that regulation could be applied to the activity, maybe not necessarily the market actor, but the market activity. And then you have other DeFi operators that, went to that DEX model 2-3 years ago to avoid having to, not necessarily for illicit purposes, but it could be user friction, like you're talking about. It could be people dropping off during sign up and wanting to, some of it I think is probably a libertarian roots in that viewpoint. So I don't think that it is or it isn't. I think there's a little bit of both. What I do think is absolutely clear is that regulation is coming, and regulators don't necessarily see DeFi, CeFi, TradFi will kind of leave to the side, but they basically, if a service is being offered, then there's probably somebody offering it. And if that's the case, we're talking about, so we'll use Aave as an example just because they've already been brought up, but Aave has a CEO. So the Aave protocol potentially is creating a marketplace for people to trade peer-to-peer, but nonetheless, there is an accountable party there. There is a universal beneficial owner there. And so when you're talking about decentralization, and this is one of the things that comes up a lot with regulators, is when is something sufficiently decentralized enough that there isn't in this accountable party here? And I don't think that we can look at enough protocols to be able to point to that answer. And if we could, then we might be able to stop having this, is it a security, is it not a security argument, right?
I can only agree. I think this, but I do think there is a moment. We're in the Napster phase, really, of DeFi. This is really early. It's great because everybody's throwing things at a wall, seeing what sticks. But in the end, it's going to come down to user interface and how things can actually be approached. And I think for institutions to get engaged, regulatory perimeters need to be defined, and this is at least a few years away. I think as a community, the best we can do is try to help educate that regulatory framework to emerge in a way that isn't too heavy-handed, that allows for innovation, but at the same time protects traditional firms, knowing that their MLROs are not going to go to jail if they do touch the sector. These are big things for money to come in at a scale that I think would grow the Precambrian explosion that we're seeing now into being something that's much more solid. But I am waiting for the Spotify, and I think there could be some Spotifys in the mix. We just don't know them yet.
That's a really great point. So I was listening to a podcast on my way over here today, and this person who is not a crypto person that just did a really cool crypto ad. I won't say who it is because I don't work with the company, I don't want to plug it, but it's really cool. Maybe you guys have seen it. And she, very famous actress, has been trying to get her arms around this, and her big piece of feedback for the crypto community is, this has just got to be easier. And so for anybody that has, played in proper DeFi, it's hard, it's expensive right now, but it falls over all the time, things don't work, your MetaVask won't, connect. It's just an enormous pain in the ass. And so that is not a criticism. I think it's new and it is nascent, and we're building cool things, and we'll figure out how to make them faster and better and more resilient. But institutions don't have that kind of time to sit for 3 hours and figure out why their MetaMask won't connect and get on Discord and talk to a whole bunch of people, and that's just not going to happen. So the infrastructure, I think, needs to be better, not just for institutions, but for all of us.
Brian?
I would just say there's a lot of my guests that are waiting and watching and seeing how it plays out, and can be a little dangerous. Like you said, if you have the CEO and the figurehead and you're located in certain countries, then you're going to hit the brunt of a lot of the regulation, and you're going to be the use case. I did use Napster back in the day, and it was amazing, although I don't use it now. Interesting. Yeah, it was super easy. One thing I do want to throw out there, just as far as stablecoins, I was at a Celsius meeting with Alex Mashinsky, and he was in London for the conference, and he told everyone there that the next war, World War III, is going to be a currency war, and it's going to be between the digital yuan and the stable US dollar. And he said, we've already known that the government is running the yuan, and all the countries around the world will have to choose. He said, the question is, do you want entrepreneurs running the stable coin or the US government running the coin? And he said, we probably know which one it is. Obviously, we've got Gary Gensler signaling that the lending of the stable coins might be a security, but also he's a very, very smart guy, probably knows more about blockchain than most of the CEOs. But he's also got a blunt instrument and he works in Washington. And as Tiana knows, is a very strange way of signaling. He's a bit of a politician. So it's very interesting to see how this plays out and then if other regulatory agencies are going to get involved. But this is a big question. And again, talk to someone like Stanley at Aave. I mean, the stable coins are where the massive amount of liquidity and margins are. So it's the space to watch.
If you're sitting there from a governmental perspective, do you see this as a big opportunity for certain regions and jurisdictions to really open themselves up to investment by taking a more relaxed approach on regulation?
Potentially, yes. I mean, I think there is a potential for regulatory arbitrage. Picking up on the point about the war, currency war, I do agree with that. I think the stakes are high for the US and China. And I think that's something that the US, just my opinion here, US government hasn't particularly got their heads around yet. I mean, it's interesting when you talk to the Circle guys, what they're doing. They're engaging with the regulator. They're trying to bring the regulator on side. Stablecoins are a massive innovation and obviously central to DeFi. And it really does, there is an onus on the regulator to engage with the community, especially with firms like Circle and others who are leading the way, because China is already there, and there is one aim, and China's already down the path. And so I do agree with that point. There's another thing here with institutions coming in, if I can sort of switch a little bit.
Yeah, absolutely.
It's still early days in DeFi. It's still early days. The markets, the depths and the liquidity, yes, there's liquidity, but from an institutional player, we're talking about traditional institutions, once that flow comes in, rates will go to, much lower than they are now, right? So I think there's something there about, the tech, as Tiana's pointed out, maturing, markets maturing so that we can provide the types of stability and rates that institutional players will want. I mean, we're working on solutions in our labs, and work with Mango Markets. And if you look at Mango Markets, USDC could be 20% this week, it could be 5%, next week. So, how do you, when you look at launching solutions from an institutional perspective, how do you actively manage that? And so all of these things have to be solved, even before, big institutional flow comes in. You and I were both out in Lisbon at Salama event. I was talking to one investor there who works with the hedge funds. He was telling me that, all the hedge funds he's engaged with want to allocate between 10 to 20% into DeFi. So that money is on the sideline waiting to come in. And so, all the things that we're doing now in the industry is to build for that eventual flow to come in.
Yeah. And anything to add to that? No?
What do you, I mean, you're in Washington, D.C. sometimes, so I'm curious, like, what do you hear and see when it comes to regulation? What can you say? Because you're probably more plugged in than any of us.
Okay, so I think that there's a couple indicators, right? So the President's Working Group convening, so there's a presidential working group on financial markets, and it technically includes 4 agencies in the U.S. The U.S. has a lot of regulators, and they convene every once in a while to discuss something. So literally, Biden himself convened the working group and added another 5 agencies to solve the stablecoin problem. That's a huge signal. That's a big deal. And so I actually, a couple of weeks ago, spent time meeting with, there's something called the Financial Services Oversight Committee, which includes those 9 agencies. And when the report came out, the President's Working Group is now referring this to the Financial Services Oversight Committee, the FSOC, which again is a big signal. So they're saying Congress needs to sort this out, or FSOC needs to review this to see if stablecoins pose a systemic risk, right? Now what's important here to note is There is no other payment system in the US that has been deemed a systemic risk. None. Not MasterCard, not Visa, not CHAPS, not, what's the US banking? What's it called? Somebody help me.
American Express?
No, the payment rail. I've just like lost my train of thought. But ACH, thank you, Chris. Come on, Chris. And so none of these things are systemically a risk, right? But somehow stablecoins might be. And when you meet with these regulators, some of the things that they've told me are deeply, deeply concerning. So I'll tell you, one major market regulator told me personally that their concern is a run-on risk of stablecoins. And I'm like, explain to me what you mean by a run risk. And the way that they're describing it indicates to me that they have no idea how people actually use stablecoins, right? Like, we're not storing a bunch of stablecoins under our mattress and we're gonna run to the bank and cash them all out at the same time, right? So there's a big gap in understanding, I think, of usage, number one. And then number two, when you have a major bill being posed within the US Congress, so the infrastructure bill, you might have seen it in the news, and there is a crypto pay-for attached to that bill, that is also a huge indicator. So they definitely know we're here, right? And they want our tax dollars, and they're gonna stick it in an infrastructure bill to pay for roads and bridges and trains. But then again, the language within that bill indicates that they don't necessarily understand the market actors and who does what, and that miners and validators are not going to be able to, send all of this information and collect all this information going back to, identity and, decentralized identifiers. It was crazy, right? So I think what does all of that mean? It, to me, indicates that something major is coming. And we have been saying, well, we want to be regulated and we want clarity. And so it is a moment of, you need to be careful what you wish for, because it's going to happen. And I would say within the next 12 to 18 months, something material and systemic will happen in the US. And then it will be up to the rest of the world to decide if it matters to them, like it has in the past with the US dollar.
I think we've all noticed that the central banks are putting CBDCs at the forefront of discussions, across the West and most countries in Asia, and Africa as well, with Nigeria. The question always goes down to who controls the money supply, and central banks are legitimately concerned if the creation of money falls outside of their control. How do they then decide what is the M1, M2, or M3 in terms of how it circulates flows of funds through the commercial banking system? It's not a bad thing for them to have a bit of challenge. We've noticed quantitative easing has kind of depreciated the legitimacy of some of the flows of funds. But I think the systemic risk, and Tina kind of explained it succinctly, is something that's not clearly understood. I think we might get it kind of being in the halfway house on this panel between traditional and crypto. We've had to think it through. But if you're sitting in I wouldn't say an ivory tower, but in a place where you are looking at policy, this is so fast moving and the actors are so unknown that I think what you're doing, Tina, is incredibly important, because you're able to voice things to people that actually need to hear what's happening at the coalface.
Yeah.
So thank you for what you're doing.
Perfect. Yeah. Thank you so much, everyone. This is all we have time for. Perfect. Thank you very much. And can we have a big hand for our panelists, please? Thank you very much. Cheers. Good stuff.
Thank you.